Hey, well, welcome to another video. Um, Glad you decided to come back and join us. This is Tom with Short Option Success, and today we're gonna start laying some groundwork as to the type of trading that we do. I do want to give you some background on it. So we do what's called short selling or selling of commodity options. And I wanted to talk just a little bit about the commodities market. A lot of people are familiar with the stock market, but maybe not so much with the commodities market. The commodities market is not companies that are bought and sold like on the stock market, but it is um, goods basically. So commodities such as grain and wheat, not grain, wheat, corn, oats, soybeans, those types of things on the grains, um, feeder cattle, live cattle, pork bellies, that sort of thing. You can literally buy and sell lumber, gasoline, crude oil, sugar, cocoa, cotton. The list is endless. There's also financial instruments. You can sell mini S&P, mini Dow, things like that. And the commodities market is sometimes synonymous with what's called the futures market, because you can buy, let's say if the current month is October, you can buy soybeans from the near month, the closest month, but you can also buy soybeans months and months and months and months in advance. In any of those markets, it's a futures market, so you don't have to purchase or trade right in the current month. You can trade in futures months, what's coming up 6 months from now, a year from now, whatever. So it's sometimes called the futures market, sometimes called the commodities market. The reason that this market exists is kind of interesting, actually. And we'll just give you an example like with wheat. Okay. So there's a lot of companies out there that use wheat to manufacture the food stuff or the pet food or the feed for livestock, that companies that manufacture these items that actually use wheat in making whatever it is they make. Let me just give you an example. Like General Mills makes a lot of different things, but some of what it makes is breakfast cereal, right? So I don't even know what kind of breakfast cereal they make anymore, but whatever they make breakfast cereal. And the danger in that is that it's hard to have a business that uses these commodities when you don't know what your supply is going to be like and how much you're going to have to pay for the raw materials out into the future. Because commodity prices are influenced by things like the weather, natural phenomenon. If a disease would go through the grain crop and kill half of the grain crop, well, the price of grains, the price of wheat or corn or soybeans is going to shoot through the roof, right? I mean, it just makes sense. So these companies needed a way to, rather than have these huge spikes and dips in the price of their ingredients, wheat being one in this example. So instead of having to deal with these huge price spikes, what's wheat going to cost us 6 months from now, and how do we plan how much cereal we're going to produce, and are we going to have enough, and what are we going to have to pay for it, and then what are we going to have to charge the consumer, and so on and so forth. That's where the futures market came into existence, and this way companies could literally purchase futures contracts, how much they thought they would need 6 months from now. They may need 200 contracts or 300 contracts of wheat 6 months from now to meet the needs of their production. So they could go to the futures market and they could buy in at the futures market, and they're buying in at today's price. And then whatever happens over the course of those 6 months, if the price was to go out of sight, they would still be okay because they would have made this huge profit being in a futures position. They would have, and the price went way up in 6 months because they're in that contract, because they bought into that futures market. They would have made money right along with it. So that at the end of the 6 months, they sell it. Yeah, they have to purchase wheat at a huge amount of money, but they just made a huge amount of money. So in essence, they have even the price out because they're still essentially buying at what they can buy for today, even though the price is much higher because they made that huge profit, which offset the cost increase in cost. Does that make sense? So that's why the futures market came to be, was so companies could do that sort of thing. Now, on the other hand, if they bought today and the price of wheat fell through the floor, and they could go ahead and they lost money on their contract. Their contract lost money as the price went down. That kind of sucks. But at the same time, they were projecting to have to spend this much on wheat, and the price is way down here 6 months out. So they're saving that much money when they actually purchase the wheat 6 months out. So again, it evens out to where they kind of know what they're paying for the commodity that they're needing. Okay. So it makes sense, right? That's why the futures market was created. So big commercial users of these commodities could even out and have a fairly accurate projection of where the pricing would be in the future as they need these commodities to do their business. Now, where does that money, whether they lose or whether they win, where does that money come from? Because every time a position is put on in the commodities market, there has to be two sides to it. For every person that goes long or buys a commodity contract, there has to be the opposite side involved to make that trade. Okay, so in order to have enough liquidity in the market so that when the producer wants to buy, go long on wheat or go short on wheat, there has to be somebody else out there to take the trade, or many somebody else's, because of the volume of contracts that General Mills is going to buy is, hundreds, if not thousands of contracts of wheat. So there has to be people on the other side of each and every one of those trades. So that is what is needed, is liquidity in the market. You need other traders. So what they did then, or what they did at the same time, but the plan was to allow individuals and trading companies to trade in these markets for the sole purpose of speculation and hoping to make money on the price movement. That's what we are. We're on the speculator side. The producers that use the commodities, they're basically hedging their bet so they know roughly what things are going to cost them in the future. Those are the hedgers, or the producers. And then you have the other side of it, in most cases, is the speculators. And that's your small traders or your institutional traders who do this in big quantities. And that's where we are. We're speculators in the market. And so speculators allow all those contracts to be filled, which adds liquidity to the market and makes the market work. Okay. So a little history lesson there. That's how that works. Now, so all these commodities are traded every day. They're traded at an exchange. There's one in New York, the New York Mercantile Exchange. There's the Chicago Mercantile Exchange, Chicago Board of Trade. These are the big exchanges in the commodities market. There's a bunch of brokers that you can open an account with a broker. If you've ever heard of TD Ameritrade, they're famous they have their online stock brokerage. Well, they've been gobbled up by Schwab now, but they're still out there, and you can still get a TD Ameritrade account that you can trade stocks with, or if you choose to trade futures, you can trade futures, and in either one, you can trade options. You have to have a little bit of experience to be able to trade options. They'll ask you some questions, but that's who I trade with, is TD Ameritrade. I use their Thinkorswim platform, and I trade in futures, but I trade in options. And instead of buying options, I sell options. So anybody that wants to buy an option, we'll talk about maybe in another video, we'll talk about exactly what an option is, because some people are confused about that. But a lot of people like to buy options because there's a finite price that you can get in with. You can never lose any more than that price, which makes it very appealing to novice traders. And they kind of look at us that do on the sell side of an option equation, because again, to do a trade, there has to be a buyer, there has to be a seller. They come together, the exchange brings them together, and a trade is consummated. I'm on the sell side, somebody else is on the buy side, and that's just how it works. Okay, so we're on the buy side of the option. Excuse me. We're not on the buy side. Somebody else is on the buy side. And I won't say I've never bought options. There are times when an option buy is a good thing, and I'll we'll get into when that is and why that is, and that's a different discussion. But in the vast majority of cases, most people are on the buy side. I'm on the sell side. I complete those transactions. And as long as the price does not move to where I've placed my options, and I'll show you that maybe in the next video of kind of how that looks. But as long as the price by expiration, because remember now, options have a finite lifespan. I get into them when they're just a little over 30 days, maybe 40 days, 45 days, sometimes 35 days before they expire. This is kind of a sweet spot, because at this point, right around 30 days, the value of a out of the money option begins to decrease fairly rapidly. And that's what I want. That's what I'm looking to capture, is that decrease in value. And so that's essentially why we sell options, and why we use the commodities market. There's a lot of reasons why we don't do this in stocks, and we can go over that at another point. But we do it in the commodities market, all that stuff, grains, cattle, soybeans, all those sorts of oddball things that are used every day, though. That's the market we trade in, and we sell options, and we're very, very profitable at it. So if you want to learn more about this, stick around, catch the next video. Make sure to give me a like if you like the video, and subscribe if you'd like to be able to get these on a regular basis. And I appreciate you watching, and we'll talk to you later. Bye-bye.